Hey traders, Nick here. I'm taking the opportunity to review a trade I just did, shared with a group of subscribers. As far as the ticker itself, this is not a recommendation to trade this particular ticker because the trade started a while back on 9/7. This is just to illustrate what I do, what I can do with a winning trade. I sometimes say lock profits, book some, take some off the table. I'm going to visualize it for you, at least the way I see it. And again, this is not a recommendation to take this trade. This was an ongoing trade that started on 9/7 for us. Okay, so 9/7, I wrote it up as a breakout above this into open air. There hasn't been anything above it. This is EWJ, but it doesn't matter what ticker it is. Into open air, if the market's is bullish, they basically can go wherever they want. The bears don't have anything to ping against. So, like if it's rallying into this, I could have shorted it here, saying it's going into a prior failure. I want to try and short it. That's doable. But when it's in open air, you don't have any references to short against, and nobody likes to short in open air. All right, so what do? Specifically, the trade was simple at the time. I just want to buy a call to capture the upside. Okay, so the call at the time that I suggested was, I believe, this one right there. And it was like 1.27, 1.3. Let's call it 1.3 for round numbers. So now it's a winning trade. And how can I lock profits? I can turn it into a spread. So if you notice, this one, if I sold it, I collect more than what I paid. So I would be in a debit call spread, which still has upside, but I got paid to be in it, or at least it was free, slightly better than free. If indeed my entry cost was 127, then this is definitely a small credit to be bullish the stock. So not only was free, it was actually better than free. Somebody paid me a little bit to be long this potential. The potential is $1 wide, and in this case it was less than free, so it's really $1. So if I did 10, it's the potential of making $1,000 out of nowhere. So I can't lose in that situation. Another way to spread it is to do the same, only short. So, okay, let's go back here. This is called a vertical call spread. I can sell this one and leave myself more upside potential. It's personal preference. But this one would only give me 90 cents, so I would still have about 20 cents deficit. Which is still cheap. But anyway, so that would be a vertical call spread. It's a call spread. It's easy to understand that part. Vertical, it's up and down in the same time frame, October. So how can I change that? I'm going to change this one to 10, and then I'm going to show both. So again, I'm long this one, and I can sell anything at or above it for current week, 4 days. So if I sell it at, like if I sell this one, I would collect $1, almost $1.10. But that wouldn't be what I would do. But technically, this would be called a call calendar spread. It's also a spread. I'm spreading it over 2 periods of time. The one I sell is shorter, so there is no extra risk. The only thing is I'm capping my profits, and that would not be what I do. This is how I would ruin a nice trade. For at least some leeway, I would go at least one up. So if I sell and collect almost 50 cents, so remember, I paid $1.30 for this one, so that's a considerable chunk of what I paid. But it's kind of like I want the rally to continue, but not too fast. Like today, it's 73.80. It's up $1. If that happens another day, this trade would lock my profits too much. So that's too close for comfort. Going to this one, it's 17 cents. You're saying, oh, it's only 17 cents. But consider that's like more than 10% of what I paid. So that's a 10% discount on my initial trade. That's not too shabby. And that gives me $2 worth of leeway. So what are these two called when I sell a call against the one I own at 73? I sell them higher. Different time frame, so it's still a call spread. It's no longer a call calendar, because we did something other than just move calendars. We moved calendars and we moved levels. So now the 73 became 75 if I chose this one. So now that's called a call diagonal. It's all the same thing. All three of those are spreads. One is a vertical spread. One is a calendar spread where I just change the calendar. I own the one at 73 out in time. I sell the one at 73 closer in time. That's not what I would do in this case. So that's called a calendar. And then the third one is not just the calendar, but calendar and also moving levels. Therefore, we call it a diagonal. It's also technically a calendar, but a diagonally set up calendar. So these are, I think now they call these like poor man's covered call. Why? Why complicate something so simple and call it something so ridiculous? Poor man's covered call. Why is it the poor man's covered? It's a smart man's covered call. Why is it any man's covered call? It's a smart person covered call. Anyway, ridiculous. It's just a name change, right? If I own a call in the future, it's like owning shares almost. Therefore, I can sell shorter dated calls against it, hopefully at the same or higher level. And if I do them at the wrong levels, I mess up a good trade completely. So please do your homework, learn them inside and out, practice with free money. Again, this was not a specific trade recommendation for outside viewers. This is merely me sharing an update on something that started on 9/7 and is up 50%, I believe, since we traded it. So it's a nice win and a breakout. I will lock some profits given the market is so edgy right now.